I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be talking to you again.
Hilliard, Terranet National Bank claims housing prices in Canada have gone up 0.7%, but again, a national average. And, of course, we know real estate is very local. So what's the real story behind that number?
Well, there's a couple of things about that number. First of all, monthly, does it really make any sense to have a monthly number? It's like, prices don't change that much in 1 month usually because there's got to be transactions. And lately, in most markets, there's very few transactions. So you don't really get a good picture on a monthly basis. The second thing to say about that is that it's a 3-month average, and then it's seasonally adjusted. So you're not going to see big moves in that index, either up or down. And they designed it that way on purpose. And thirdly, it's very regional, as you said in the intro. Toronto is going up still. Ottawa is going up still. Even Edmonton's going up, but Calgary and Vancouver are dropping, especially Vancouver. Vancouver is the weakest of the bunch. So overall, it's a slight increase, but in certain markets like Vancouver, prices are very weak.
And of course, the biggest fall here has been in Canada's highest income postal code, West Vancouver. Can people there, I mean, we're seeing houses drop there from 14 million to 10 million, drops like that, right?
I just saw, now this is the first, like you and I talked several times about the, from April when there was that house that was, listed at, 11 million, dropped to 5.5 million, but it was on one of the top streets, overlooking the ocean and all that. And it was a huge property and a huge house and fairly recently built. However, I just saw a listing this morning, that sold. And now these are the rough numbers, but it was a 53% decrease, but it was a condo. So it was assessed. It must be a very luxurious condo. It was assessed close to $3 million and it sold for about $1.5 million. So that I think is I think that the drop was 53%. So that is a new, development because, a lot of the condo, prices have been mostly determined by the new condos. There haven't been a lot of resales. In my experience, when I interview people that own condos, they tend to hang on to them if they can't get a good price for them. They just rent them out. So you don't really get a good sense of where the used condo market is going. And it gets skewed by the new buildings, which in Vancouver anyway, for the last few years have been more and more, every building is more luxurious than the last building. So the prices are higher and higher. So this is a new development where you get in actually in the resale condo. So that'll be something to watch closely.
Well, even in the neighborhood I'm in New Westminster, they've built some new towers and the prices in those brand new towers are coming down. They were $500,000 for 500 square feet and they've dropped in price. It's incredible how many amenities they can cram into 500 square feet.
Yeah, well, of course, they give you amenities in the building, too, like the party room and the fitness workout room and the concierge and all that. But, after a very brief time, probably measured in weeks, certainly no longer than months, people get tired of paying for all that. So that's where you get into the trouble. And then when you go to sell the condo, all the buyers, as a used condo, all the buyers looking at is maybe the square feet and the price, and doesn't really care about if it's got a party room or not. So it's there's all that razzle dazzle of the new amenities when they're selling a new building, and I think it helps sell the property. But what people don't realize about condos is it's basically a losing proposition, no matter what happens, because in the long run, the only thing that goes up in value is the land. And in a condo, of course, you've got too much building. Generally, the building is like 90% of the initial purchase price and not enough land.
Also, too, in Vancouver, though, there isn't a lot of new land to build in, and that keeps the price for the land up. Also, I've noticed in some older buildings, because right at the peak of the market, condos were selling for $630,000, but originally were assessed at $400,000. Now the rest of the people in that building feel they can still get $630,000, but truly you're still in a $400,000 unit building.
You know, the older buildings are interesting because some of them have actually quite a bit of land, divided over a smaller number of units. So my criticism of condos is I'm thinking more of the high-rise, recently built ones where there's a tiny amount of land and a very large, tower that goes 20 or 30 stories. But some of the older buildings in Edmonton and Calgary and Vancouver and Toronto, they actually have quite a bit of land. So that would be the exception if you got an older building. But I'm thinking about the brand new buildings where people are paying a very high price for the shiny brand new, let's call it, and not getting very much land in exchange. And from now on in Toronto, Vancouver, you won't get very much land. It's hard to imagine anybody building a condo with a low density. You do have properties like that in London and New York and places like that where you've got these connected townhomes in a row, and you get quite a bit of land, and those are very valuable. And that's what I think would be maybe a nice thing to have in some markets, moving away from single-family homes, because you hear more and more people saying, I don't really need the yard. I don't use the yard. As you get older, you don't sit out in the yard very often, and you don't have kids that run around in the yard. So eliminate the yard, and then you don't have to buy as much land.
Now, Ottawa has improved the most in terms of price. Is that because it's considered a city of permanent jobs? Yeah, government jobs, right? It can work the other way too, though. We had it in Edmonton in the 1990s, where Edmonton is considered a government, healthcare, and university area compared to Calgary, which is more of a head office company headquarters. And in Edmonton, the real estate got hit much harder in the mid-1990s when Ralph Klein, the premier at that time, was putting through his government cuts. So, and we've got a new government in Alberta that is talking about doing the same thing, some massive cuts. And when they come in and say, the first thing they say is, we'll cut out all the bureaucracy and all of the waste and the fat and get rid of the fat, and that'll cut 30%, let's say, just to pick a number. And then they find out that actually that's not, the administration is a fairly small amount of the total cost. So when they actually are determined to cut, they end up cutting real services and real jobs like nurses and teachers and people like that. So, and since the 1990s, the government didn't really grow that much. The huge growth was in the consultants. So now they've got all these consultants and all these people that are paid through the government payroll, but they're not necessarily permanent employees of government. So a place like Edmonton or Ottawa, when a government comes in that is more conservative and more wants to cut, they could hit the housing market quite. It certainly did in Edmonton in the mid-90s. Now, in the case of Ottawa, I'm not aware of when it might have hit. The only person that really cut spending in government was Paul Martin in the mid-1990s, when the government of Canada was pretty deeply in debt, and I'm not aware of how much of a correction. There was a correction in the housing market, but I'm not aware of the details. Of course, Ottawa too is part of Canada's multiple little Silicon Valleys. That could also be a factor.
Yeah, I think Ontario, I don't know that Ottawa would be the right place, but certainly if you had a company in Toronto and we're paying $50 a square foot rent and your employees had to commute for 2 hours each way every day to get to work, you might consider moving outside of the Toronto, the GTA as they call it. I don't know if you pick Ottawa. You might pick Waterloo or London or someplace like that.
We'll have more with Hilliard Macbeth right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, we keep hearing noises that the U.S. Fed is looking at very low interest rates, perhaps negative interest rates. If negative interest rates were so helpful, how come Japan hasn't crawled out of what seems to be a permanent recession since they ruled the financial world back in the late 80s?
Exactly. I actually devote a whole chapter in the second edition of the book to the Japan experience, and one of the reasons I decided to do that was because I met economist Richard Werner is his name, and he worked in Japan during that initial. The bubble started to burst in 1989, and then various Japanese governments tried to deal with the fallout from that. They lowered interest rates to close to zero. Right now, the interest rate, the benchmark interest rate in Japan is minus 0.5%, and it didn't really have that much stimulus effect. And even today, it's not really the contraction has kind of ended and things seem to have bottomed, but Werner, the economist, points out that low interest rates by themselves are not enough. You need to have different ways of stimulating the economy beyond just setting the price of credit. Because if people don't want to take credit, you can't force them to take it even at a negative interest rate. So what he actually is the person that coined the term quantitative easing, but what he was talking about was actually directing the growth of credit to what he calls GDP useful functions. Not like we have in Canada, unfortunately, where people are using credit to speculate in real estate, which is not a particularly helpful to employment or GDP, but directed more through the banks to useful and the kind of projects that will lay the groundwork for future growth for many years to come. And Japan, at the time, Werner was there, and he proposed quantitative easing to them in Japan, but they didn't take him up on it. They did what they called quantitative easing, but it wasn't enough. The problem with quantitative easing of the nature that's usually done is the money that is created just ends up staying inside the central bank and the reserves and never actually gets out into financing useful projects. So, according to Werner, the government that came closest to implementing what he recommends was the U.S. government after the 2009 global financial crisis. And interestingly, it's the only economy right now in the world that's doing really well. Europe is flat to maybe declining slightly. Germany is on the brink of going into recession. Japan is certainly not that attractive. The U.S. has been expanding at the fastest rate of any of the countries in the world, of the big developed countries. So, but that's not good enough, because the President of the United States is calling for a 100 basis point cut to the Federal Reserve rate.
Now, if you're not in recession, it's unusual to be cutting interest rates. Do you think the Fed has now become a political tool rather than a financial or treasury tool?
Well, it certainly looks that way. There was two at the last meeting, and actually, interesting enough, the minutes come out tomorrow on Wednesday. So we'll see. But there were two dissenters, which is fairly unusual, actually. A fellow from Boston, Rosengren is his name, and a woman, and I forget where she's from, but they both dissented from at the last meeting. And they didn't feel that it warranted cuts because the economy is quite strong, and why are we cutting? And so now the reality is if they do cut, and this is empirically been proven, the central banks of the world, not just the Federal Reserve, but the Bank of Canada, the Bank of England, the ECB in Europe, and the Bank of Japan, they tend to follow the economy rather than lead it. So if there's a 100 basis point cut, unless they're basically just doing what the president is telling them to do, it'll probably be because the economy is very weak. And sometimes what it have the impact on the market would be a negative impact, because people are going to say, whoa, wait a minute, if they're cutting 100 basis points, that means the economy is very weak, and I don't want to borrow any money, and I don't want to do anything. I'm going to wait and see what happens. So that's the risk. And Keynes talked about that in 1936. He said there's a point where cutting interest rates causes people to get more cautious instead of more aggressive. And that's the danger we've reached. Now, I don't know if the solution isn't to raise interest rates, but cutting interest rates by themselves has been proven in Japan. It doesn't necessarily work the way people think it might.
Also, when you cut interest rates, you take the foundation of several pension plans out from underneath them. And although in Canada we're told our national pension plan is well funded, it's also invested in the stock market. If that plunges, what happens to our pension?
Yeah, one of the biggest things, you're exactly right about pension plans. They rely on bonds, but they've also, because of some extraordinary returns out of Yale, there was a money manager at Yale University has this huge endowment fund, and they went into alternative assets, like directly investing in private equity, real estate, all this infrastructure, that sort of thing, away from bonds and stocks. And so the pension plans all decided that they would do that too. And so the Canada Pension Plan has a very big department. They invest directly in things like in China and places like that. But the problem with all those alternative investments is they're not liquid at all. So, and the returns basically only come when you sell them. And in certain markets, you're not able to sell them. So now the Canada Pension Plan has a very large amount of money, and I think $117 billion. But interestingly, we're 2 months or 3 months away from the start of the year to 2020, when the Canada Pension Plan will start for the very first time in the history of Canada, paying out more money than it has been paid in. So the aging of the population means that there's people that are receiving the Canada Pension have finally become greater than the people that are working and paying into the Canada Pension.
Is that one of the reasons why Canada is hot on immigration? We need young people to pay into the pension?
Yeah, I don't know if that's the thinking, but that certainly would help. You've got Japan and China. Interestingly enough, people don't talk about China. China, the aging of the population is even faster than Japan. And it's because of the one-child policy that was in place up until recently for several decades. So China, Japan, perhaps Canada, perhaps even the United States, depending on immigration, because certainly politically immigration seems to be become a real hot button issue, and politicians may not be able to keep the immigration rates up as high as they have been. It's interesting, if you did GDP per capita, you'd find that a lot of the countries in the world that have fast immigration are not actually growing much at all, but they never reported on that basis.
We'll have more with Hilliard Macbeth right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, Aramco, the Arabian oil company, is looking to reoffering its initial public offering. It would be the biggest in the world, I believe.
It'll be the biggest ever, I'm sure. I don't remember the exact numbers, but it was in the trillions of dollars. And even though they're only offering a small fraction of the total value of the company. But it's interesting. I was looking at today by coincidence, and the biggest company listed is ExxonMobil, which has been around for 50 years or more, and they currently are at the lowest ever ratio of value to the stock market. So you take the S&P 500, the ExxonMobil's been in there for more than 40 years, and then you take the value of the share price of ExxonMobil, and it's the lowest ever. It's down to about 20% of the peak. The peak was reached in about 2008 when oil hit $140 a barrel, and now it's down to a very tiny fraction of that amount. So it might not be the best time to do an initial public offering of an oil company, but on the other hand, maybe the Saudi government feels that they better do it now because 2 or 3 years from now, they might be worse than it is now.
Well, it seems with the push for electric cars and so many governments being anti-fossil fuel across the planet, that sell your oil now while you still have the chance.
Yeah, and the biggest oil producer now in the world has become the U.S. It's taken over from Russia and Saudi Arabia. So the phenomenal story of doubling the oil production in the United States, mostly due to shale oil in Texas, but in other areas as well, is just doesn't get enough attention. And that may be what's spooking Saudi, because their exports to the U.S. have been steadily dropping, and now they're exporting to other areas. Don't have oil. There's lots of big countries like Japan and China that don't have much oil. But the writing may be on the wall that oil is going to be a less important commodity. And that'll be a big change, because for the last 50 years, going back to the OPEC, the forming of OPEC in the mid-1970s, oil has been the single most important commodity traded worldwide, and it makes up a big percentage of the global trade, and it's generally traded in U.S. dollars as well. So oil and the U.S. dollar have been dominant for many, many decades, and someday it'll come to an end. But hard to imagine it happening quickly. It's probably more likely to happen slowly.
Well, thanks to the show's good friend Stuart Muir, who was digging through Statistics Canada figures, Canada imports $34 billion worth of fossil fuel every year. He says that's the rate of $4 million worth every hour. Well, that's money that we could be keeping home if we had a pipeline all the way east. Yeah,
it's interesting. I don't think that pipeline is going to get built because it was blocked by several governments. But then on the other hand too, pipelines generally cost about $5 a barrel to ship. But on the ocean, transport is quite a bit cheaper than that. With the new carriers now, you can get $100 million or even more dollars worth of oil in one ship. So it's quite easy to buy it elsewhere. So would Eastern Canada want to buy it from Alberta at a higher price, or would they be willing to buy it from some place like Libya or Saudi Arabia at a lower price?
Well, Western Canada Select is $10 or less a barrel than the world price.
But their refineries in the east are not set up to handle that particular type of crude. The best market for that Western Canada Select is in the U.S. At the end of the Keystone Pipeline, they're hoping to do an expansion called Keystone XL. but there already are 3 phases of the Keystone Pipeline built, and the best refinery for that is located at the end of that pipeline. And interestingly enough, since we're talking about Saudi Aramco owns 100% of that refinery. So we ship it. So this is how crazy it is. We ship Alberta oil to the U.S. to be refined in a refinery owned by Saudi Arabia. It certainly is a big change since I started in the investment business 41 years ago. It's a completely different story. And, who knows? It's certainly the one thing we do know for sure is it doesn't make a whole lot of sense to be shipping this stuff by rail cars. But first of all, it's expensive, and maybe even more importantly, it's much riskier than a pipeline if there's a crash or a derailment or something like that.
Yeah, but the difference is by rail, you don't have to have federal government hearings that get protested.
Yeah, and you don't have to build a pipeline. So the fact that so much of it's going by rail makes me wonder if the people that are selling oil are thinking maybe this, as you mentioned a minute ago, maybe this is an industry that is in decline, and the faster way to get it out, even though they have to pay $15 a barrel, 3 times the $5 a barrel that a pipeline costs. If you're only going to do it for a few years and then you're going to stop doing it, maybe it's cheaper than building, a multi-billion-dollar pipeline that takes several years to build. And if that pipeline only operates for 5 years and then there's no reason to operate it anymore, that's going to be a huge loss for somebody.
Is the Alberta government still going ahead with the purchase of 2 entire trains to carry oil?
I don't know. I think I saw something that they were rethinking that decision, and I don't know. I think they, it's interesting. It happened before with Lougheed in the 80s, where he bought a bunch of rail cars to ship wheat because there was a concern that the 2 railways weren't doing enough for the wheat farmers. But so this is maybe a similar thing. And it's nice to have when you see those. I think they were blue with orange lettering, which
yes, they were.
It happened to be the colors of the Progressive Conservative Party under Lougheed, right? So was like a little advertisement every time one of those cars went by.
Yes, and the SkyTrain cars in BC were painted the Socred Party colors.
There you go. So, who knows if it makes sense economically, but it might make sense for other reasons.
Hilliard, thank you so much for chatting with us.
Nice to be with you.
My guest has been Hilliard Macbeth, author of the 2nd edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash. If you have any questions for Hilliard or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.